Hey guys, it's Keenan with the Real Estate Exchange. We got Adam over here with First Rate Financial and the Real Estate Exchange. So Adam, I get asked all the time, like, what are all these loan products that we have out there? Like, I want to buy my first time home buyer loan, which is not necessarily a real thing. For the record, there is nothing that you don't write down on the offer, first time home buyer. But there are a lot of loan products out there. You know, government-backed loans, conventional loan products. Could you just kind of give us a little intro, break it down real quick, and when someone says, hey, what loan do I want, what are these loans?
Absolutely. Great question, Keenan. So really, loans break down into two primary categories.
Okay.
You have conventional loans, and then you have government loans, all right? And right there, the difference is that a government loan carries a measure of government insurance behind it. The government's not lending money, mind you. The government just insures the loan for the lender, all right? A conventional loan means there's no government involvement at all. So it's just you and the bank, no middleman, all right? And all loans are based on a balancing of risk and a reward for the lender or the investor. And so the government kind of mitigates or neuters that risk to a large degree for the end investor, as the government says, hey, if the borrower does not pay the money back, we'll pay it back. Uncle Sam will pay you the money back so that you don't lose money on this deal, right? The conventional loan, there is no government insurance in place, and therefore those loans are more risky to the bank, and the bank is generally going to expect a higher rate of return. It also means that they are more heavily grading you or judging you on the risk that you inherently bring to the transaction. All right?
So basically you got small down payments is most likely government backed. Big down payments is not government backed because there's no reason to back that property, because if you don't make your payment starting on day one, your down payment was big enough for the bank to take it back, sell that property, and not lose any money. Less risk.
Correct. That has a lot to do with it, Keenan. That's good insight. I would add, though, that if you want to do a conventional loan for a single family owner-occupied, the conventional market has shown that those loans perform very, very well. And so there are a lot of very low down payment loans, conventional loans for well-qualified borrowers. We even have a 1% down conventional loan, 3% down conventional loan, 5% down. So if you want to buy a single family home and live there, there are a lot of really fantastic options for the well-qualified borrower. And that would lead me into the next part of what we should discuss is well-qualified, all right? So the government has a financial incentive for all Americans to own a home and to realize the American dream, right?
Yep.
The more that middle America owns homes, the better it is for the entire economy. And so what the government does is the government insures these loans to more risky individuals that the conventional market would otherwise want to finance. So if you have very low credit scores, or if you have a higher than normal debt to income ratio, or if you haven't been at your job very long, or if you move jobs frequently, or if you have some other moving parts to your financing, that government loan is going to be better for you. And what the government is doing there is they're taking those less qualified folks, as well as some more qualified folks who they attract to these government programs with low interest rates. They push all of it into one big pool, and it's the better qualified folks that are subsidizing the insurance program for the lesser qualified folks, all right? Now, if you are on the lower end of that qualified spectrum, this is definitely a 2 thumbs up scenario for you, because you are getting a way better deal than if you went to the conventional bank yourself and said, I got some stuff to deal with, right? So you're definitely getting a way better deal. However, if you want to buy a single family home to live in and you're a more qualified individual, the only benefit that you gain from this government program is to subsidize less qualified people's risks, which is like, that's a 2 thumbs down scenario, all right, for the record. So if you want to buy single family and you want to live in it and you're a well-qualified person, you do not want a government loan. The way that the government attracts people like this, like the honeypot that they're using to get the more qualified folks into this pile of mortgage loans, is through those low interest rates. So a government loan is going to have the lowest interest rate of any other loan offering out there. The catch, though, is that mortgage insurance. And that mortgage insurance is substantially more expensive, again, for a well-qualified individual than they could get by going to the banks themselves, right?
What if you want to make money?
That's a good question. Good question. So if you are a more qualified person and you want to buy a multifamily property, multifamily is a different game. And so as Keenan had pointed out earlier, if you want to buy a multifamily property through a conventional loan, they expect a minimum of 20 or maybe even 25% down payment, which is a lot more than you can get away with on a government loan. So as a well-qualified guy, if I want to buy a multifamily property, what I've done then is I've taken this large area of risk to the bank and I've inserted it into my well-qualified life. If that's the case, I'm going to want to jump me as a borrower, I'm going to jump from that conventional back into that government subsidized program and let someone else wash my risk so that I get the better deal. So a well-qualified guy who wants to buy a multifamily home, I would add a tag, it's got to be owner-occupied. You got to live in the building. But you're way better off using that government subsidized program and getting in with a substantially lower down payment. VA 0 down, FHA 3.5% down.
So is it additional risk if it's obviously not owner-occupied, because if they don't make the payment, they still have somewhere to live. So where does this additional risk come from just switching over to multifamily? Because it seemed to me, buying a home that has, where I have 100% of the debt owed to me versus multifamily where I still have 100% of the debt owed to me, but I got other people helping me pay it. Seems like that's less risk.
True, I would agree, and in the real world that oftentimes happens. When you look at the banking industry has been around for hundreds of years, way longer than either of us, and we'll be here long after we're gone, right? And so the conventional banking system and industry is making decisions based on past performance of their loan products. And so when they look back, specifically during this big, economic collapse that we had a few years ago, they're looking at who paid their bills and who didn't. And when they look at multifamily properties, they do not perform as well, historically speaking, as owner-occupied homes. All right, and that's largely because if I had to guess here a little bit, that even if you buy a multifamily as your home, the odds are that you're not going to be there very long term because the building's going to make you money, right? That's the whole point.
Especially if I don't live there.
Exactly, right? So you buy it as your home for a year or two, then you move out, right? And so those loans, the people are still even going to live in, they don't live there permanently. And then when something goes wrong later down the road, and that person has an issue in their life, and they have to make a decision between making the payment on my home or the payment on my fourplex, well, it's a pretty easy choice. I'm keeping the roof over my family's head, right? And so if you look at even an owner-occupied, most owner-occupied programs for multifamily, they still want, around a 20% down payment, which is substantial.
Yeah, excellent. Well, thanks a lot, Adam. If you're out there looking for a property, you want to know more about loan products, Adam's definitely the guy to go see. If you're looking for a great deal, I might know a guy. But anyway, thanks for listening, guys. Please follow us on our social media. We've got Instagram, we've got YouTube. We're going to be pumping out a bunch of free content for you. So like this video, share this video, spread the word around, have your people get in touch with us. We got your back.
See you soon.